Over the past couple of videos, I've been buying more A&W stock. And in this video today, we're dedicated to analyzing the A&W stock and why it might be a good recession-proof stock. We're going to analyze it versus its competitors and see how it performs. And there's also going to be one stock at the end that I'll mention that I think is actually better than A&W, but I'll give my reasons why I'm not investing in that stock. But before diving into everything, we got to talk about today's sponsor, Neo. Just the other day, I received the Neo credit card in the mail. And the best thing about Neo is that you've got two routes for applying for the credit card. One, the traditional route, if you got a good credit score, you'll automatically get the card. And if you don't have a good credit score, you can get the secure credit card. Basically what you're doing here is putting money into the account so you never go over this balance. That way you'll avoid the position of paying interest on your credit card payments because you literally can't go over that limit. And you might be wondering, why would you ever go that route? Well, you also earn rewards on your purchases. So this is better than a debit card, which typically gives you 0% cash back. On average, if you're spending at a partner with Neo, you're going to see around 5% cash back and up to a maximum of around 15%. But this varies based on the offers that they currently have. Neo also offers a high interest savings account which pays higher interest than EQ Bank. Currently, it promotes a 1.8% interest on the account, versus EQ Bank, you're sitting at around 1.65. If you sign up down below for the credit card today, you'll get $50, and it's possible you can get an additional $10 for opening up that savings account. So now let's go back to the program where I'm analyzing A&W stock. The first thing that you have to know about this stock is that they don't actually own the A&W stores. This is a royalty income corp. This stock, or actually fund, is called A&W Revenue Royalty Income Fund. Essentially how this fund works is that they own the trademark A&W, and they license that trademark out to all the different A&W restaurants in Canada. And as payment, they receive 3% of A&W's top line sales out of all the restaurants in Canada. And currently there's just north of 1,000 A&W restaurants in Canada. Since 2002, they've doubled the restaurant count from around 500 to 1,000 restaurants, so this brand is growing quickly. Now if you look at the stock chart, and you can search up the ticker symbol AW.UN, and it trades on the TSX, you can see that from inception in 2002, the stock has gained about 232%. Now if we compare that to the S&P 500, January 2022 all the way to now, the S&P 500 has grown about 236%, so a 4% difference. But we're not including the dividends that A&W has been paying out. Currently, the dividend yield for A&W is sitting around 5%. So if we actually look at the dividends reinvested over the years, you can see the chart that A&W provides. They completely blow the S&P 500 out of the water if we compare the dividends reinvested into the stock. Now the real reason why I'm making the video today is that I believe A&W is a recession-proof stock. And because the news is going on and on about how there's going to be a recession soon, well, why not look at stocks that could be defensive in our portfolios to help us weather this recession? So we already know A&W supports a 5% dividend, and they'll probably continue paying that. The only time they stopped paying this dividend is because of COVID, and that's because all the restaurants shut down and the management decided to withhold some cash, not knowing what would be in store for the future. But however, if you look at the payout ratio in 2021, when restaurants started to reopen, the payout ratio exceeded 100%. And the reason is management is actually held to a standard where they're supposed to pay out almost all the earnings to their shareholders. That's just how this royalty income fund works. It's similar to how REITs work, where they have to pay up to around 90 to 100% of the income that they received from their properties. The only things that get subtracted from the revenue is expenses, which are like the employee's income, but that's fairly minimal overhead. And because the future seemed a lot brighter in 2021, they decided to pay out their reserves, and that's why they had a payout ratio over 100%. But the reason why I say A&W is a recession-proof stock is when I looked at the stock over 2008 and 2009, when we had the last stock market crash in an actual recession, A&W, how their sales fared was that they grew their sales during this time. In 2008, they grew their sales, the same store sales, by 1.5%, but the total revenue increased by about 5%. And that's with the addition of new A&W restaurants. In 2010, they continued that growth, just getting north of a 5% increase in total revenue. Now, if you look at the rest of the stock market, most of the stocks in 2008 and 2009, which weren't in the quick service restaurant industry, they actually saw a decline in sales. And also some restaurants in the same industry as A&W, where they're quick service restaurants like Tim Hortons, they saw their sales decline by around 3%. and Burger King saw their sales in 2010 decline by about 2 to 3% depending on the geographical area. The reason I bring up Tim Hortons and Burger King is because these two companies plus a few others are combined under one ticker symbol QSR, or this is Restaurant Brands International. And this is the one company we're going to be comparing A&W with today because both of them trade on the TSX. So as I mentioned earlier, Tim Hortons sales actually dropped during the stock market crash. And if you look at the pandemic, Tim Hortons sales and Burger King sales dropped by around 8 to 12%, whereas A&W sales dropped by around 9%. So it kind of averages out. And it's fairly obvious that this wasn't a recession that caused it, it's because they were restricted from having people dine in and fewer people went out. But in a recession environment, that's different from what we had during COVID. This is when people stop spending as much. And people who don't cook and always eat out, they're obviously going to cut their spending budgets and go to quick service restaurants like A&W. And one thing that I do notice about A&W, just a personal anecdote, is that I always see coupons for them in the mail. Whereas Tim Hortons and Burger King, I don't really see those. A&W is always at the forefront of your mind, pretty much every month or every 2 months when they send out coupons. Now let's take a look at the revenue growth since 2015. QSR actually had a spike in revenue from 2014 to 2015, and that's because I believe that was when the merger between Burger King and Tim Hortons happened. So let's take the numbers from 2015 onwards so we have a consistent basis to go off for our revenue. They did do an acquisition of Popeyes somewhere in there, I believe, but we'll just give that as an advantage to QSR. And if we look at the numbers, QSR grew the revenue by around 29% from 2015 all the way to 2021. Now A&W grew their revenue by about 48%. This is a combination of increasing same-store sales as well as expanding with more restaurants in Canada. If you look at the dividend growth of these two companies, QSR wins by a mile. And the reason is if you go back in time around 2015-2016, the payout ratio was only around 29 to 30%. However, today in 2022, the payout ratio is somewhere around 80%. That's how they were able to grow their quarterly revenue from around 10 to 15 cents per share all the way to about 53 cents per share today. But QSR isn't under the same governance that A&W Revenue Royalty Income Fund is under. The income fund has to pay out pretty much all their cash that they receive in that quarter or in that month to shareholders, versus QSR is just a regular company and they can keep as much as they want to reinvest in growth and pay out the rest to shareholders. But seeing as they're at around an 80% payout ratio, they only have about 20% more to go in increasing the dividend from around the low 4%, and if they increase it 100%, that would hit about 5%, which is on par with A&W. So in terms of the actual dividend potential here, I think that QSR and A&W are pretty much on par. But one thing that you have to know about QSR's dividend versus A&W's dividend is that QSR is an eligible dividend, which means that you pay lower tax. If you're in the highest income tax bracket, according to this article, you're paying somewhere around 39% for the dividend. However, for A&W, because it's a non-eligible dividend, you're paying around 48% tax on that. If you're buying at a TFSA though, I believe, I'm not an accountant, but I believe you don't actually have to pay tax on it, even though it's a non-eligible dividend. The one advantage I will give QSR here in a recession is that it's got diversification of brands as well as locations around the world. A&W, the Royalty Income Fund, is only located in Canada, versus QSR has restaurants all over the world, as well as it has 4 different brands. It's got Burger King, Tim Hortons, they've also got Popeyes, which is a somewhat recent addition, as well as Firehouse Subs, which just closed earlier this year. Personally, I think Firehouse Subs and Popeyes are the better brands in my eyes. Tim Hortons and Burger King, I'm not a big fan of. If I'm going to go get a burger, I'd rather go to A&W or McDonald's. And for me, I don't really drink coffee, and Tim Hortons has just a lot of high sugar things like donuts and muffins. And right now, that's not really what I'm looking for. But in my personal circle, I do feel Tim Hortons doesn't have as loyal of a following that it did about 10 or 15 years ago. Nowadays, I think people would agree Starbucks coffee tastes the best, even though you're paying a little bit more for it. People are willing to fork out the extra $1 for that. But hey, if you disagree with me, let me know in the comments down below, because it would be interesting to see what you guys think about these restaurants that Restaurant Brand International holds. And what are your thoughts on A&W? For me, I have seen A&W grow in the Waterloo region, and there's actually an A&W that opened up very close by. And clearly it is expanding based on its restaurant count, And new restaurants opening is one of the main avenues for A&W to continue to increase their dividend. So that's personally why I'm invested in A&W in my TFSA fund, because I do believe over the long term, they're going to continue to grow the restaurant numbers in Canada, and that's going to produce more and more revenue for this income fund, which pays me out monthly. And the best part about monthly income is just seeing dollars hit your bank account. And I can spend that and reinvest it into new stocks or buy more A&W stock, which will continue to snowball that dividend. And right now with a 5% dividend and a tax-free savings account, that's pretty good for me. Personally for me, when I retire, the goal is to earn 4% of dividends of my portfolio. So A&W currently at 5% exceeds that 4% mark that I'm hoping for in the future. Now I did mention earlier on the video that I have one stock that I think would be better than A&W. However, I'm not purchasing that, and this stock is McDonald's. McDonald's was one of the best performers in the recession. They grew their sales by around 4.6%, which actually matches A&W. But where McDonald's is stronger is its brand value. Everyone knows McDonald's around the world, they have great pricing power, and they also are one of the cheapest fast foods out there with their dollar menu. So this attracts a lot of people because if you want a cheap meal and you don't want to spend that much, you go to McDonald's. And McDonald's, they continue to grow their dividends every single year. They've consecutively increased their dividend for 43 years. Currently, its payout ratio is around 56%. So if they were to go all the way to 100%, they could pay around a 4% dividend. Currently, the dividend sits just above 2%. But the reason why I'm not purchasing McDonald's in my TFSA account is because I have to buy it in USD, and that's what I don't want to do in this Wealthsimple trade portfolio. And converting to USD, where there's also withholding tax for those dividends, and it gets a little bit messy there. I do believe that A&W has a shot at matching McDonald's performance over the long term from here on out. McDonald's currently trades at a P ratio of around 26, which is a premium for its category, versus A&W trades around 17, which is very close with where QSR trades at. But whichever stock that you go with, Restaurant Brands International, A&W, or McDonald's, I'm sure you will do fairly well in a recession. Now, if we look back at the data in 2008, this is one last fact that I got for you guys. If we look at A&W stock right before the huge drop, it took them around 5 months to recover. If we look at McDonald's, it almost seems like the recession didn't even happen for McDonald's. They were pretty much bouncing around the same level and quickly shot up as people realized that McDonald's is a recession-proof stock. And if you look at the S&P 500, it took about 17 months for it to recover, since around September 2008 when the whole market started to crash. So that's the data that I want to present to you guys today about A&W. Let me know your thoughts down below. If you guys found this interesting, are there points that you think that maybe I missed about this company, or do you disagree about certain things? Let's have a conversation down there. If you guys also have other stocks that you want me to analyze, let me know in the comments down below, because I will be continuing to do these stock analysis videos, and I'm always interested in what stocks you guys are interested in. I've already got my next company lined up, and you'll have to wait and see for that video, so be sure to subscribe down below. I've got a couple videos up on the screen here. If you're interested in those, you can check them out. If not, keep up the grind and have a great day.